we broke the upper resistance level, right? So quite honestly, it's telling me that it could either go back down and test that 20-to-1 ratio, and it could go back up and test that, well, it'll go past that 100-to-1 ratio. We don't know. Time is going to tell us which way or the other, but we can pay attention to where we are right now, and at 56-to-1 or 58-to-1, whatever that ratio is telling you, let's see if it goes down to bounce on that 50-to-1. If it does and it comes back up, then it's more likely to go above the 100-to-1. If it doesn't and it continues going through that level, then it's more likely to test that bottom ratio again. So that's why pattern shifts, and I talk about them all the time, because they help you see what is the next most likely outcome. I can't give you any guarantees, but frankly, when I go to these technical levels, it really doesn't matter what you're looking at.
Lynette explains that breaking the upper resistance in the gold-silver ratio signals a major pattern shift, with current levels near 56, 58-to-1 determining the next move. Lynette will now show that during past crises 1999, 2008, 2011, and 2020 gold and silver first moved together. Then silver often accelerated faster once the financial stress became clear. By watching whether the ratio bounces near 50-to-1 or breaks lower, she says we can gauge whether silver is about to outperform again, as it has in previous monetary disruptions. If this historical breakdown helping you, like the video and subscribe for more insights on gold, silver, and real money. Let us know in the comments what you think the gold-silver ratio is signaling next.
You can see back in, what was that date, 99, when we had actually the first derivative explosion, but we'll just stay here for today. And you can see how both spot gold and silver kind of followed the same trajectory. And then we saw a greater move above it back in 2011, right? So the financial crisis became apparent to everybody in 2008. It was happening before that, but the public couldn't see it. So there was a flight to safety, and you can see that spot silver reacted more than spot gold did during that period of time. But that's also when there was a pattern shift, and you can see how both of those lines kind of trended afterwards. In, 2020? Then you can see how the spot silver, that red line, moved up much more quickly. So there are definitely times when spot gold will move faster than spot silver, or spot silver will move faster than spot gold.
Lynette shows that silver has been outperforming gold both long-term and short-term, with the gold-to-silver ratio falling sharply since 2025 as silver accelerates. She explains that the ratio typically narrows first, then widens again during hyperinflation, using Weimar, Germany, as a clear historical example. During that collapse, both gold and silver preserved purchasing power as the currency failed, with silver excelling for day-to-day barter and gold for large-scale wealth protection. Her key point: metals aren't really going up, paper currencies are being debased by massive money printing, just as they are today.
You can certainly see pretty clearly that red line, that silver has moved exponentially faster than spot gold in this longer-term relative performance chart. And this is just another one, a shorter term, where you can see where that diversion really took place, right? So this is everything this is about, is giving you the tools to make educated choices. And if I don't think we've done one. So we'll get that done. Just look for it tomorrow. It'll be less than a minute. It's not going to take very long. And this is the gold to silver ratio since the beginning of 2025. And you can see how that has gone down, right? From 105 in April of 2025. So testing that resistance level on the top, to whatever it is right now, 66, 68 to 1. But I've also told you many times that we will see that ratio grow more narrow. And then once we go into hyperinflation, then it changes again and it'll grow wider. So I pulled up the data from Weimar Republic in Germany, and not because that's the worst case, but because it's the most well-known case. And this is the data that I pulled on what happened to spot silver during that period of time. So this is 1919 and 1923, and it went from about 150 marks to an ounce to, let's see, hundreds, thousands, millions, billions, a trillion marks per ounce of silver. So it definitely enabled you to continue to buy food and whatever else you needed on a day-to-day basis. And it's why I like silver for barterability. But here is what happened to gold during that same period of time, or the spot gold market. Same period of time. That started out at 110 marks per ounce of gold and went up to 10 trillion marks per ounce of gold. And by the way, guys, is this really gold and silver going up, or is it the mark going down because of all of the money printing that the government did to pay for all of the spending that they weren't earning?
Lynette explains that in past hyperinflationary periods, silver initially rose faster than gold, driving the ratio down toward 25 to 1, before later exploding wider toward 100 to 1. She stresses that physical gold and silver should not be treated as short-term trades, since timing and fees work against you. Instead, she views physical metals as a long-term strategy for preserving purchasing power, not a vehicle for quick speculation. Let's listen to Lynette now.
And here you go, just like what we're experiencing today, spot silver moved up faster than spot gold. Both of them were moving up, but spot silver moved up faster, took it down to the 25 to 1, and then it was off to the races at the end of this, and it ended up at 100 to 1. I can show you more examples, and if you want them, let me know. I can do a whole piece just on the silver-gold ratio during hyperinflation, and if that's something that would be interesting to you, I could put that on my very long list of videos to create. But essentially, I wanted you to see where we are, because I never look at silver or gold as a trade. If you want to look at it short-term trade, there are much better vehicles than the physical markets. Really, don't do that with the physical, because there's timing, and then there's also the fees involved and all of that. There are cheaper ways if what you're interested in, or even partially, because it never has to be all or none, if you're looking to capture this. And now you know, I mean, go back. Oh, let's see. I don't think I can. I have to go back through each one. So this is kind of like a pain in the neck, but I'll do it quickly. I think it's the one that I want before this. Yeah, this one. Okay. So if you're thinking about doing this as a trade, pay attention to, and you have the links to everything anyway, so you can actually even go onto long-term trends and pull this particular chart.
Lynette explains that for centuries, starting in 1693, gold and silver circulated together at a stable 15 to 1 ratio, with both metals recognized as money at equal stated value. That ratio held until just before 1913, when a major pattern shift occurred, signaling a fundamental change in the monetary system. Her key point is that recognizing these pattern shifts gives an early warning of systemic change, even without knowing every underlying cause.
So this is, in the beginning, that 20th of an ounce of gold to 1 ounce of silver to a silver certificate, all in circulation at the same time at the same stated value. This takes you all the way back to 1693. So, you hear a lot about the 15 to 1 ratio. Well, that was from 1693 up until shortly before 1913, when we had a little bit of shift, but that was the norm. And you can see it stayed very steady for 15 ounces of silver to 1 ounce of gold. But then there was a pattern shift. That's why I always talk about the pattern shifts, because you don't need to really understand exactly why something is shifting. When it shifts, it gives you a heads up. And we could see that pattern shift that happened right before 1913.
If this historical breakdown helping you, like the video and subscribe for more insights on gold, silver, and real money. Let us know in the comments what you think the gold-silver ratio is signaling next.